Best loser wins. What the hell does that even mean? How are you supposed to make money if you're focusing on losing? Well, I think there's a lot to be said with that. For one, just in the human condition, you want to be a graceful loser, I suppose. But in the trading world, your gains only look like gains to the extent that you keep your losses small, right? That was in the first few pages of The Inner Voice of Trading. By the way, if you're new to the show, thank you very much for being here. I'm Michael Martin. I'm a trader speculator based in Los Angeles, trading stocks, futures, and options. I wrote The Inner Voice of Trading in 2011. I give the audiobook version away. You can see it in the description of most of these videos. You can get it for free. The book itself has 4.5 out of 5 stars at Amazon, so I'm told. I don't really look at that stuff. Egos, and pride's a big banana peel. But I realized when I was first starting that I'd find myself in some of these winning trades, but it was my reluctance to take small losses that really wiped out the profits. So I might find myself, and I gave the example, I think, where I was like, I had a bunch of trades on, some were plus 25, others were minus 25. And so the equity in the account didn't do anything, right? We talked about that yesterday, is like when you look at what you're making on a per trade basis, how does that move the needle on the account? Because that to me is the number that you're trying to grow, not necessarily sit there and punch the air like you're nailing a trade, for a small bit of capital. And so that's when I really learned the importance of needing to offset the losses very, very quickly. The problem for me was that, and this is not really a problem, so it's a wink, wink, is on the equity side, right? Because I was trading like blue chip equities and commodity futures, which is really what I started to focus on. The problem I had with stocks is that I knew the names. I had patronized the establishments, if you will. I had bought their goods or services. So I knew the company. So it kind of gave me a bias. I was like, man, I've been to, Wendy's quick service restaurant, and the guy was still alive doing those, commercials. I knew, everything that I was connected to. And that gave me a subtle emotional connection because I had a familiarity, right? And so I had to let go of that and just say, I got to just look at the numbers. I just have to look at the numbers. And if I buy something at 10 and it goes down, a dollar, I wasn't really buying $10 stocks, but the analogy is like, if I'm going to stop and say at 10%, if the thing is off 10% from where I bought it, I have to trade it. I don't care how blue chip of a blue chip it is. It's got to go. And I showed in the book anyway how if I had just kept all my losses at 10% from the entry price and I let the winners go over the same period of time, my portfolio would have been up 3 or 4%. And I couldn't even demonstrate that I had skill at that point. It was just a function of keeping the losses small. So you can go a long way with that. And that's the key, especially when you're learning, because you don't know where your skill is. You can't define your trading edge. We talked about that Monday. You have to look at the math. The math will tell you where the expected value is, and that can help you pan for the gold and say, okay, let me further isolate these types of trades. Like, what am I really good at? I might really love options because I love all the sophistication of it and all the moving parts. But if you're only making 10% on your equity, where your stock trading is making 21%, you got to go where the love is, right? You can be an options enthusiast and still watch all the options people. There's certainly plenty of them. So I had to look deep within myself and say, okay, I have to learn how to be a good loser because it's letting those losses become bigger than they should. That's robbing me from the winners that I would get, even if those winners were from good luck or good timing. Because at the beginning, I didn't know any analysis whatsoever. I didn't really have analysis. I thought I did. But at the beginning, what you think is analysis isn't necessarily analysis, but you do it anyway because you don't know what you're doing. And you do have to put in your hours. And that's why you learn to appreciate money, is because you're putting the time in. So, learning to be a good loser means letting go of all the hard work and the hours. For me, it was hours. I was putting in hours and hours and hours of, studying charts, reading fundamental analysis, asking other people their opinion on stuff. Because at the beginning, I didn't know. And I was hungry enough to have the humility to ask for help. So the thing is that I could have decided on my own from day one is that there's an uncle point. If I put on a trade, doesn't matter what the instrument is, I have to let it go. And I suppose it's just hitting me right now. That was one of the reasons why I let go of trading options and interbank foreign exchange early on, is because I didn't know what I was doing. I didn't have any clues as to where I could go. My own analysis wasn't helping me. And I felt at the time I had exhausted all the resources that were most immediate to me in and around trading those instruments. So I didn't need a loss leader on my business. I had plenty of those, right, from other areas. So I said I could always come back to them because they're not going away. Options aren't going to go away. Although at the time they were still kind of new when you think about it. Now it's a gigantic industry, but if you think about the origination of not over-the-counter options like what Victor Sperandia was trading when he was younger, I'm just talking about exchange-listed options. When I started in the business, they weren't very old. It wasn't that big of an industry at the time. But I was like, okay, I'm going to put that aside. I can come back to it. Let me focus on where I am getting results. Again, whether it was based on good luck or good timing, I couldn't tell, but I needed to go again where the love was. And then isolate the winners from there. And then I think what I did was, which was a little trickier from a business building standpoint, because you got to remember I was inside the wirehouse, there were far more people, like 20 to 1, who were ready, willing, and able to have a discussion about a stock, but there weren't that many people who were up on commodity futures, never mind how do you trade them, never mind the fact that you needed, I remember mentioning this in one of the shows, like, you had to really prove an enormous amount of financial wherewithal if you were going to open up a futures trading account at that time. And you needed, roughly $125,000 liquid in the account with a net worth that I'm sure was $500 to $1 million. So there were all these litmus tests that you had to go through. So I made it a lot harder on myself to focus on that type of business because it was much more stringent to open up an account. Now anyone who could fog a mirror can basically open up an online futures account, which I don't necessarily think is a good thing. But so be it. I'm libertarian probably at the end of the day, so it's buyer beware. If you go put and fund the account and try to trade it and lose all your money, you have some responsibility in that. Being naive doesn't make the other side, culpable. But you have to figure out, like, why did they take the big, the five. When I started, the S&P 500 contract was in fact 500. It wasn't 50. And what do I mean by that? It was $500 a point. The margin was $39,000, $40,000 a contract, which meant it was clearly institutional. It wasn't a retail product. And so you have to understand that the business, although it makes you think that they're doing you a favor by chopping the contract into a tenth, which is what it is, which is why the E-mini, a full point, is $50. It's 1/10 of what it used to be when I started. I don't necessarily think that's a good thing. Sure, they can say that it's the most popular contract, it's the most heavily traded. That's true. But I also remember that in 82 to 87, a lot of people lost money, and it was a raging bull market. I also know from 95 to 2000, for all the money that was made, people got killed. Interestingly enough, if you look at 95 to 2000, what were the darlings of those days, right? Because the darlings changed. They become memeified. Well, you had, CMGI and Vertical Net, Siebel System, Global Crossing, and people made a killing in those. But those were also the same names where people lost the most money. So you're going to see that with the Magnificent Seven too. Because if you don't have a strategy, if you don't know what your trading edge is, like we talked about Monday, you're just trying to surf the waves that you have no idea how to surf. So what everyone else might be making money with, you're going to be losing because you don't know what you're doing, and or you're doing what I'm talking about today, is you didn't learn how to be a good loser. If, MSTR and Smart Micro and Bitcoin and Coco and all the darlings of the day are on the news every day, it fills the bias and makes you feel like you're a loser if you're not in those trades, because everyone else is making money, obviously. You're not going to have a guy come on TV, hey, I'm Mike Martin, my expertise is tax loss carry forwards. If you have too much abundance in your life, give me your money because I'll lose it without even trying. I'm a natural. You just tank your account, no problem. It's like I don't even need to try. I can just subvert your capital and your family and ruin your life. And that's why I'm on the show here today, talk about the other side of it. What a boner killer, right? Like no one's gonna want to have that on TV. All they do is parade, somebody, who's had some success. We talked about that. I won't bother you with the details, but it's lopsided. It's not there to really serve you, And I don't mean to be cynical, but you have to kind of see it for what it is. And one thing that you can do is to say, okay, I might understand, so at this point in my career, I understand the commodities markets because I've lived them. I am the commodity markets. I know the fundamentals. I know the players. I know the people on the physical side. There's no information that I can't get. And that helps me out quite a bit. But it helps me avoid situations that I otherwise might get into because now I have better information. But the single best thing that you can do, that everybody can do to help their trading, is to keep their losses small. The problem is that people get emotionally invested in the outcome of these things, or they see a $200 move on MicroStrategy and they're like, oh my God, I couldn't even get $5 out of it. But the idea is like, if that's not your trade, then it's not really a missed opportunity because you have no business being in there in the first place, you see? So when you learn to become a good loser, all you're really saying is like, you're not a loser. It's not losing behavior. It's actually winning behavior because keeping your losses smaller is part of the game. That's winning behavior. Let your winners run. That's winning behavior. Cut your losers short. That's winning behavior. Employing a time stop. Whereas if you looked at putting on a trade and normally that you see the thing move within a certain period of time and it doesn't happen, the momentum may have stalled, in which case you can just get out of the trade for just a few ticks. So it won't be big losses or big gains. But you'll just remove that risk. Because in my experience, if the momentum stalls right when you get into a trade, to me, sooner or later, it will work against you. So I never, ever give it that opportunity. That's called a time stop. So learn to be a good loser, not because you're happy about taking losers or you are a loser. That's not what that implies at all. Being a good loser really just means you're going to be the sentry on your account balance. You have to learn how to preserve your capital. And that means knowing how to offset those trades that aren't working out for you right away. Again, I'll go back to Alan A. Greenberg, who was running the prop desk at Bear Stearns, was one of the best prop trading outfits in the history of Wall Street. He didn't care how blue chip it was. If the trade itself was losing money, not even at the maximum spot where it would get stopped, you don't take losers home over the weekend. What you do during the week, at least for their trading desk, was one thing. But even he said if it was McDonald's or AT&T, if the position was down even 3/8, they never took losers home. And I think that's one of the reasons why they did so well trading, is that they just never emphasized their losers. And that does wonders for your emotional constitution too, because now you're not sitting there putting any effort into that. Again, Pareto efficiency. You don't want to spend your time babysitting losing positions. Get them the fuck out of your portfolio. Focus on what's winning. How can you add to your winners? The conversation should be constantly going back to what's working. How can you get more of it? How can you take your unrealized gains, adjust your stops, invest your gains into your protective stops, and then let the winners run? Anyway, more videos like that right here.